dot-com bubble, also known as the dot-com boom, was a stock market bubble in the late 1990s, more specifically throughout 1995 to 2002. The American Stock Exchange during that period from 95 all the way to 2000 managed to rise 400%, only to fall 78% from its peak by October 2002, losing pretty much all of its gains during the massive upswing of the previous years. Even though the tide was tough back then, many of the companies we know of today, such as Amazon, eBay, Google, and many more were able to pull through and become the global conglomerates of the 21st century. What could have caused such a massive collapse? Was it really unlucky timing? Well, experts in finance and economics are pretty certain about their claims on what caused the massive fall of the stock market. But to understand their claims, a thorough understanding of the previous years during the creation and distribution of the internet is mandatory. In the early 1990s, the first web browsers started to pop up, which in the following years gave computer users access to the World Wide Web, popularizing the term we know of today, the Internet. Between 1990 and 1997, the percentage of households in the United States owning computers increased from 15% to 35%, as computer ownership progressed from a luxury to a necessity. This marked the shift to the information age, an economy based on information technology, and many new companies were founded. At the same time, a decline in interest rates increased the availability of capital. The Taxpayer relief of '97, which lowered the top marginal capital gains tax of the United States, also made people more willing to make more speculative investments. Alan Greenspan, then chair of the Federal Reserve, allegedly fueled investments in the stock market by putting a positive spin on stock valuations. He also raised interest rates several times. These actions were believed by many to have caused the bursting of the dot-com bubble 3 years later. According to Paul Krugman, professor of economics at the University of New York at that time, however, he didn't raise interest rates to curb the market's enthusiasm. He didn't even seek to impose margin requirements on stock market investors. Instead, it is alleged he waited until the bubble burst, as it did in 2000, then tried to clean up the mess afterward. In addition, the Telecommunications Act of '96 was expected to result in many new technologies from which many people wanted to profit. So all in all, greedy investors, in combination with the low interest rates of '98 and '99, facilitated an increase in startup companies, many of which lacked realistic plans and administrative ability but were able to sell their ideas to investors because of the novelty of the dot-com concept. Venture capital was easy to raise. Investment banks, which profited significantly from initial public offerings, IPOs, fueled speculation and encouraged risky investment in technology. A great example, Netscape, which was an American independent computer services company, managed to pretty much triple its value as a whole on the first day of going public from $28 per share to $75+ per share. A combination of rapidly increasing stock prices such as this one in the quaternary sector of the economy and confidence that the companies would earn future profits created an environment in which many investors were willing to overlook traditional metrics such as the price-earnings ratio and base confidence on technological advancements, leading to a stock market bubble. As expected, the majority failed to become profitable before burning through all of their venture capital and started to close one after the other. By the end of '99 and early 2000s, at least 100 companies that got caught in the web of severe overvaluations had gone under. Japan also at that time, 3 days after the Nasdaq hit its all-time high at the 10th of March of 2000, declared that it has once again entered the recession. This started a massive collapse of the sector as investor sentiment and fear rose to all-time highs and unprecedented amount of dollars touching the $5 trillion mark in market capitalization were wiped out of the economy and the stock market. This left investors and many companies in scrambles as they were trying to collect the pieces of what was left. It took the market 16 years since the massive collapse to return to the previous all-time highs of the internet craze. So what do we learn from this whole situation? Probably a good way to look at it is to compare it with the striking similarities of today's greedy and overly confident crypto and NFT investors. Perhaps the next market bubble has already been created. If you enjoyed this video and found it informative, please let us know down below by leaving a like and maybe a comment. You are free to dislike the video if you found it misleading and even correct us if something we shared with you was misinformation. Again, thank you for watching and see you again on the next video. Until then, have a great day.